Today, I'll be talking about Fibonacci retracement strategy, and it will help you as well in trending markets that obey the Fibonacci strategy. Now, why I am specifying that is that it's not every asset that will obey the Fibonacci. So it is left for you that when you are using this strategy, you have to test it at first on the type of asset that you are trading to ensure that it is actually following the Fibonacci retracement rules. So it is not applicable for every pair. But then there are some pairs that will obey it very well and very perfect. So when you meet such type of pairs and you love the Fibonacci strategy, then it will be the best for you, especially as a beginner. So I'm going to show you guys what the Fibonacci tool is and then how to apply it. Now you must have sound knowledge of market structure. If you don't know how the market moves, it will be difficult for you to use this tool. It becomes very, very easy if you can draw the swing highs and swing lows. So to identify the tool, this is trading view. It is located by the left. That's where the tools are located. And it is the third row. So you click on that arrow and then you see it here, the Fib retracement tool. So when you click, this is how it will appear. But then I have modified my own. So I'm going to show you how you can modify yours as well. So any tool that you pick on TradingView, you can double click on it and then you can set any setting or modify it the way you want. Now I can double click on this tool here and it will show me the settings. Let me double click. You can see settings for coordinates, for styling. You can see it everywhere here. Or when you highlight the tool by clicking once on it, you will see an option will appear for you. So you see this setting, you can now click it. It's the same thing as double clicking it as well. So I'm going to reset everything the way your own is going to appear. That's how you will see it appear too. So under the templates. So I'm going to apply all the defaults. Then I'll click on OK. So when you first come, this is how your tool is going to, when you are using this tool for the first time, this is how it will appear. This is how it's going to appear for you. You will see it like this. Very long, lengthy. So you are going to see it like this. It has different colors. The numbers, these are the numbers you are interested in. All these numbers, you are seeing them. So you can set them as percentages, or they can simply be as decimals. It does not matter whether it is percentage or it is a decimal. It really doesn't matter. If I know that this is 0.7 is the same thing as 70%, if I know this 0.6 is the same as 61%, if I know this 0.5, I know it's the same thing as 50%. So whether yours is having percentage or you want to change it to percentage, it's still the same thing. Just not those numbers that are on it. So let me enlarge it for you guys to see how the numbers are. So you can see this, the starting point, this is 0, and then 0.236, 0.382, 0.5, 0.618, 0.786, 1, then 1.618. But it's not everything that you are going to make use of it. There are certain ones that you don't really need. There are certain ones that you don't need. So the ones that most of the traders, they pay attention to it is the 0.618 and then 0.5. In between this 0.618 and 0.5, or the 50%, in between the 50% and the 61.8%, that gap that exists is known as the golden zone. The golden zone. So from here, in between, the gap that exists is known as the golden zone. And it's golden in the sense that every trader that knows how to trade using this, they are putting their eyes on these particular levels. So anytime the price reaches that level, you see that most times there will be a reaction around this level of 0.618 and the 0.5. I'm not saying that other levels are not important. Other levels are important as well. Like this 0.236, you may find out that another asset or instrument that you are trading may be obeying only the 0.236. Or you may find another one may be obeying only the 0.382. So whenever you are testing your Fibonacci tool or your Fibonacci strategy on any asset, check to see which level is obeyed. And once you know the level that is being obeyed, you will wait for price around that point. Once it reaches there, you will go in. That is how simple it is. But then most traders, I told you, is this 0.5 or 50% and 0.618. These are the two levels that people set their eyes on them. Other ones, rarely. Now, since we know that other levels are not being obeyed, I can clear out other things to just remove the clutter to allow me to like view it clear. Because when the market, when you are measuring this thing and you see sometimes the retracement may be so close or tiny, you will see that these numbers, they will clock together and you can't really read them well. So in that case, you can modify this thing and then you will remove the unnecessary numbers that you don't want. And to do that, you will simply double click, or when you click on it once, then you can, this option that appears, you can click on the settings. And you can see the levels around here. These are the ones that you don't, so you untick the ones that you don't want. I don't want the 2.618. I don't want this other one. Then even this one too, the 0.236, I don't need it. 0.786, I don't need it. 0.16, I don't need. 0.36, I don't need it. So it's just 0.5, 0.382, and 0.618. Those are the levels that I am interested in them. You set it. You know, you can see now, as I set the thing now, you can see how it's appearing, so that I can just easily focus on these points, these 3 points now. But the most important one is 0.618 and then 0.5, like I earlier said. So now how can you use, or how can you apply the Fibonacci tool? I said that you must look for an asset that obeys the Fibonacci strategy. There are certain assets or instruments or Forex pairs that don't obey the Fibonacci strategy. So in such case, if you pick your Fibonacci tool and you find out that it is not obeying it or the market is not trending, just simply avoid it. It's not a must. If that is your strategy, don't trade that market or don't trade that asset. Even an asset that obeys it, sometimes it may be accumulating. So when market is not trending, you cannot use the Fibonacci tool. When market is trending, but yet is not obeying those levels, don't use the Fibonacci strategy or the tool. So these two conditions must be met, that the asset you are trading must obey it and it must be trending. If it is not trending, you cannot use it. So it's only used in a trending market. And I will show you how you can identify those trending markets. So if your Fibonacci strategy fails, then it means market wants to reverse direction. But if market does not want to reverse direction, it will continue to be valid. Now, what you need to do is that anytime you come to your chart as this, hover over the price and then click this A that you are seeing to fit the candlesticks. After that, you need to shrink the chart. If you hover over the lower part of trading view, you see this plus and negative. You can shrink it by reducing it, reducing it, reducing it, or you can use your laptop. Mine, I'm using Windows, so I can easily shrink with my 2 fingers. It does the same thing as this other negative sign that you are seeing. Now you can see how perfect this thing is. A trending market is a market that keeps forming. If it is trending upward, it keeps breaking highs, but it will not come down to break the previous low. So you see, this was a low. The market moves to form a very high point. The highest point is what you are interested in. Then it comes down to form another lowest point. Now, this is the part that is very important for you to apply the Fibonacci strategy. If you missed any of these swing highs and swing lows, you will always get it wrong, and it will be hitting your stop loss. So you pay attention. You see, this is a swing low because this high gave rise to this lowest point before pushing up. So the lowest point that the highest point gave rise to, this is for an uptrend. I will do for a downtrend for you people when I finish too. So this highest point gave rise to this lowest point before pushing up. So is this lowest point that now gave rise to this high here that gave rise to this low here, and then another high here that gave rise to this lowest point here, and then this here, and then it gave rise to this lowest point here, and it continues like that to this lowest point here, and then now currently it is here, and we can see that the market is retracing over here. This is how to draw your swing highs and swing lows, and these are the points that we are going to use to draw our Fibonacci tool. So now pick your Fibonacci tool. I have it here under my favorites or shortcuts. So what I'm going to do now is to click on it. You are going to start drawing. For an uptrend, market is moving from down to up, down to up. So you are going to start drawing it from there, from the lowest point here. You draw it to the highest point that it reached, and then you stop there. Now, this is the highest point that it reached before it started retracing. Pulling backwards is what is known as a retracement. So this is the level. Now, price is here. Now, you see these lines are not close to where price is currently, like this part where I am considering. Okay, so I want to drag this to close to it, but then I have to maintain this level. This highest point here must be maintained. So be careful that when you are dragging it, you shouldn't bend it and drag it like this, because by doing that, this highest point is not at this other highest point here. So you must adjust it, that even if you drag it like this, it should adjust to that highest point. So you can see now, if I enlarge this thing for you, you can see the points that are obeyed. It means anytime the price enters our golden zone, see the reaction. It enters our golden zone without breaking the 0.618. It pushes up. And one thing with the Fibonacci strategy is that as far as that market is continuing with that trend, you are not the one controlling the market. That's why the day it does not work, it means market wants to reverse. So you can see now that as soon as price reached inside of the golden zone that I told you about, the 0.618 and 0.5 in between them, market pushed back, and it must clear the high that gave rise to this low. So this is the low, but it originated from this high point that it kept retracing until it reached the lowest point and entered inside the golden zone, and then it pushed up. So where are you going to enter? Where are you going to set your stop loss and your take profit point? You will enter anytime market enters inside your 0.5 or 0.618. You see, it could not touch the 0.618 level, but it's still within the golden zone. So if you see that this, you keep measuring it from previous things, and you see that most times it touches 0.5 or 0.618, just put it in between. you enter at that point in between. Then look for any low. Look at this low now that is here. You can adjust your stop loss to be around that point. Ensure that this green point, this your target point, that by the time it clears this high, it should give you 1 to 2 minimum. So let's stretch it to the highest point here. You see it's giving us 2.5. So we will leave it at this point. So if you reach 100, you are getting 250. Okay. That is how to trade the Fibonacci. So your target point is you are targeting this high. It can keep going higher than that one, but then target this one, because sometimes if market wants to reverse, it may even come close to this high, but it will not clear the high. So you see, even clearing the high is not even the best, but you can adjust it just before it clears the high, so that even if market comes back and did not go past this point and begins to change direction again, it will still give you something. That is one trade that you have taken. Now, if you are done with this part now, let me shift it. If you want to draw the next one, you pick your tool again. Market has now broken this point. You are going to wait for the market when he starts coming down, like the way it's coming down like this one. When you start seeing market, instead of going up, it's now going downwards, deep, then you know it is retracing. Start from the lowest point again. You push it up to the highest point where it reached and you started seeing that retracement. You can see that this particular one obeyed the 0.382, this particular one. But then most people will not enter. So if you see that 0.382, you shouldn't, because it's going to increase your risks. The only safe point, let me tell you guys the truth, the only safe point for you is the next low to set as your stop loss point. So imagine if you are buying at a high point over here, very high over here, you are going to increase your risks, because the only safe point will be this other low for you to set as stop loss, because you are not sure now that it has not even entered the 0.5 and the 0.618. So if you are using this, you will be skeptical, because by the time you put it that it should be around this point, what if the market now comes back to enter the golden zone before finally pushing up, just as what happened over here? Let me delete this for you to see it. So you see, market started retracing, it entered the 0.382 and then pushed up again. You see, market went up but could not go further. It had to still come back into the golden zone, which is the 0.5 and then in between 0.618. So you can even see from here that this market loves obeying that 0.5. So you will wait for it always around here, this 0.5. If we extend it while maintaining the highest point where it reached, you can see that the market obeyed that 0.5% or 50%. Okay. Then from here again, you will do the same thing. You pick your tool again. You are going to draw it from this lowest point where it reached to the highest point it reached before it started coming down. You are going to draw it. So you extend it. Now look at it at this highest point. This is where it reached before it started dropping. So you extend it so that you see what will happen to the price in the future. Now you can see the next one. Now, instead of it obeying the 0.5, it did not. Obeying the 0.618, it did not. It came down so close to almost that last part, the last low. But if this price now had gone down lower and you see a candlestick with a full body on 15 minutes, if it has closed below this particular low, then you can say there's a change of character. But it came so close to the previous low without clearing this low. Market has not changed any direction, it's still in an uptrend. That is how to use market structure to know when there is a change of character and a reversal in the trend. If you had been trading the 50%, like once market enters your golden zone and you put your stop loss just below here, this would have hit you. So that's one of the disadvantages. But then if you are the type that puts your stop loss below the previous lows, because for this market to continue a trend, it will not come back to any low that it has already formed. Look at it from here. A low here went to form a high. Then this low was formed. It went to form another high. Now you can see all the lows don't come back to clear these lows. So the only safe place, like I told you initially, will be a previous low. But then if you are doing like that, your risk to reward is going to reduce. So that's why they tell you that you have to choose your poison in trading. It's either you say anytime that you enter for a trade, you put it just below the 0.618, since you know that this type of market, as the way we are seeing it, it obeys the 0.5. So always your stop loss is going to be below, just a little below the 0.618. So if this type hits you and still go the direction again, that's just it. Is part of the trading for you. That's why you have to maintain your risk amount every trade. Be maintaining it. Know how to manage your capital. You don't just do things haphazard. Today you use $10, tomorrow is 20, next is 50. You reduce to 5. Then the 105 now gives you times 3 profit only, but it's only giving you $15 now as profit. Then the next day now you see another opportunity, you enter, and then you, instead of risking the same 5, you are now risking 20. Then it's that day that the thing decided to go against you. Then it takes your $20. You won't make progress. So just fix specific amount. If you are losing, lose very low. If you are winning, win high. So it ensures that every trade you should measure it, that you should win with what? A minimum. Use the same risk amount. So if you are trading with 10, depending on how you can withstand it without it affecting your emotions. So if you are using $10, use $10 for every trade, depending on your capital. So you see, like this one now, if you are just putting it below the 0.618, this one will hit you. That doesn't mean that you were wrong. You were just following your trading plan. Because there is no way you will predict the market 100% and say that, okay, I know that it's going to come down here the next. You can even still put this thing below here, and market has decided to change direction and it will still come and hit you. So if market is hitting you, let it hit you early. There's nothing wrong with that. You can see now, from here, market pushed up again to clear this high. So I told you your target is anytime you enter should be the next high, should be cleared. But then I want to show you guys something, even in this one as well. Let me delete this too. And then you can see, let me also delete this one to clear the gap. Even in moving up to this, you can see there's a retracement even inside. Is still trending. The whole of this part that you are seeing, but the whole from here to here is one single retracement. But then as it is going, it is still trending as it is pushing up. So the whole of this thing that you are seeing here is a single push moving in that same direction, continuing with the trend. But then as it is continuing with the trend, you can even see that inside of it, it is still trending up and down, up and down. It is still trending. You can still apply Fibonacci in it because you can see that it's still obeying that same law. But then you should know it's a single move of the market. So in this particular one now, you can see again, let's draw our two from this low, reach the highest point. Where is the highest point that it reached? This point, draw it across. This is the point I'm talking about. You can see that upon reaching the 0.5, so let me enlarge it for you guys to see. So upon reaching the 0.5, look at it. Market pushed up again, coming close to the 0.6. So your stop loss, I told you, should always be here. So if I'm to enter and you are entering at the halfway between, like halfway of the golden zone, this will be halfway. So you enter halfway and then your stop loss will just be below, the 0.618, and you will target the high. Then this is the high that first. So you are targeting that one to clear it. You are targeting to clear it. And you see it gives you times 4. Times 4. So if you were to enter here, this market will come and give you times 4 here. So if you are risking 10, it's giving you 40 by just obeying this. Once it's done, shift it, or you can delete it to give you space. We are done with this from this point to this point now. So the next low, you will start from there again. So I'm going to delete this to clear the space for us so that I can explain it well. So this was the low that gave rise to the next high. So let's see. Use our tool again. So this, from this low now, you are pushing up to this high. Then you extend. But you can see now, upon reaching here, it started coming down. I told you, once you start seeing it going deep, just pull out your retracement tool and wait for it around here. But instead of it turning around the 0.5 or 0.6, it rather turned at 0.382. So in this type of trade, you will not enter. But you know, sometimes when you see that it's going up now, fear will catch you, or that you have that anxiety that this market is going and leaving me. That's not how to trade. You must develop that patience by force for you to succeed. If you don't develop this patience, that every opportunity you see that you don't want to miss it, forget about it. You are just wasting your time. So you have to wait for it. And let me give you guys this thing practical. If on this particular day you took a trade, this was 6th of January, you took a trade, and then you came and you measured it again, and you were waiting for it to come down here. This was on the 7th. It did not. You waited again, still it did not. This was on the 8th. Look at the time frame as I'm shifting. This is on the 8th now. Look at it on the 8th. Nothing is happening. Do you think you have that patience to wait even on the 9th? 3 days now gone, no, nothing will happen. It means that whole week, if you were to obey this thing, that whole week is just once now you have taken a trade. It's just once. When you will know that this market did not obey this thing is if another high was cleared. You see, this high now was cleared. Look at it over here. It was cleared. So as it's cleared by this particular price now, it dropped down again. So from this lowest point where it reached, it means you will never take this trade. So you are not supposed to take that trade. So I am going to pull it up again. So let's pull it from this low that it reached. So if you are entering, you will enter at the 0.5 and you set your stop loss below the 0.618, and you will aim to clear the high that gave rise to that, the high that gave rise to it. So you have 2.5 as your risk to reward ratio. You can see how easy it is if you understand market structure. So this is how to use the Fibonacci retracement tool. It's a very good strategy for beginners. Now that is for an uptrend. For a downtrend, I'm just going to show you how to draw it, but it's not that it's a must for me to repeat what I have done again. So for a downtrend, you start from the high point. Since it's going downward, you are going to start from the high point and go down. So market started here, it pushed down and then retraced. So going up now is the retracement for a downtrend or a pullback. Then it pushed down again, then it retraced, then it pushed down. You see, so you can just pick your tool anytime the market has started making the push to this and then started going backward. You see, this is the type that I told you that it can be so tiny that the numbers may be so clogged together. If I had not removed those unnecessary ones, you won't see these points clearly. So let me extend the graph for you to at least to help you see it clearly. So you can see that the market entered the 0.5. It did not reach the 0.618 again. This market is just, in fact, it seems I'll put an eye on this particular asset this week. I don't trade any other thing apart from GBP USD, but I'm seeing it is obeying this thing so perfect. So for this particular one now, you can see it obeyed this 0.5 and did not reach the 0.618. So it seems it's the 0.5 that is favorite for it. So now you enter for a sell at the point just halfway through. You can see halfway through, enter there, put your stop loss. Don't be afraid that stop loss is close to where you are good, because you have known that that's what the market obeys. Why do you want to putting it wide? Does not mean market cannot go that direction. If it decides to go, it will go. It will go. So it's of no use whether you are putting it, let it go and reach heaven, or you are pushing it down. It will still follow you there if it wants to go that direction. You are not the one pushing the market. That's why they told you that if you have seen a certain pattern that a market follows like this one, simply put it above that 0.618. And then when you enter, always aim to clear this other part that gave rise to that point where you are entering. So like this particular one now is a low we are aiming to clear. So we adjust our take profit point to be this, and you have 3.5 as your risk to reward ratio. You can see it. You now hit this trade. Move to the next one. Let me delete this to clear space. So you start again from this point where it dropped to clear this. When it's clearing, leave it. Leave it. Don't say that, okay, I shouldn't have exited here. You are following trading plan. You are following a trading plan. As far as it has cleared your low here, allow it to go down. Whether it's entering inside hellfire, allow it. Let him retrace back. These things is patience. Okay? So start from this low again. Click down to where it reached and then extend. You can see as soon as it entered the 5, it did not obey, but you are going to enter around here for a sell again halfway through, because that is your plan, that halfway through you just enter. Depending on how you put your pips above, it may hit if it's so too close, depending on how, like I told you, if it will hit, it will hit. Like yesterday, the day before yesterday, when it hit us, immediately it started reversing without even going down further again. You can see how irritating it can get. So it's not that it's your fault. You can't, these things are probabilities. That's why you must protect your capital always. So this may just come close. You may think, that's why they told you, if something did not hit your stop loss, don't close that trade. Leave it like that. So you will aim to clear this particular low. And you can see you have cleared it with risk to reward of 4.3. But I always check for this 4. Let me delete to clear space. You start again from this point down, but then you want a deep retracement. You see what I'm telling you, it happens on GBP USD. It will start doing without giving a full retracement. If this price did not give you a full retracement, see it going inside, pushing inside. But this one will not. It will just do something like this without giving, then it will start dropping with speed. You won't have any option. And one thing with this type of market is that you won't know where to set you as your take profit, because it may come back and then begin to go up. And you can't just blindly say it must reach a certain level. You will not know. So I don't really like trading markets that I don't know where I will set as take profit. And I don't know where I will set as stop loss. Because if you are to remain safe in this market, if you are to enter here, you must put your stop loss to be above this previous high, because you don't expect price to go and clear this high. So you have to put it up like that in order to to clear this other low. So what will be your risk to like this? You don't trade like this. This is not trading, and you can't extend it because you will never know whether market will even come and reach here. They are not ready to give you opportunity, so let them continue their thing. When they are ready, you will see the opportunity. Okay. You are talking of checking for a reversal pattern.
At that golden zone, or you just enter like that.
Okay, for this particular market, you can see it does not give you any reversal. Once it enters there, it just starts pushing up. It does not give you any reversal pattern for this particular one. Okay. So you have to, that's why at the beginning of the class, I guess you are not there at the beginning. You must first apply that tool. You must first apply the tool to check if the tool is obeying those reversal patterns. If you see that it prints a certain reversal pattern before moving up, then you wait for that reversal pattern. But if you see that immediately it enters that 0.5, it does not pass 0.618, then it pushes up. Then you just have to wait for it like that. Okay. That is how it is. But then for others, you will see that they must print reversal patterns. If it gives you those reversal patterns, then fine. Okay, so if there's none, then we will end this thing for today.